at 5 o'clock UAE time. We went from $66 at 5 o'clock here. At 7 o'clock, we're close to $68. So it was a stark reminder of who is investing in this market and where money flow is coming in. Liquidity, of course, was low throughout the day because a lot of people are off, like I said. And then Wall Street came in, decided that the US economy is doing great. We don't care about anyone else. And we're going to back our own economy. And up we went to 68. I think that will be the theme of the week going forward, to be honest.
That Kevin Wright, lead analyst APAC for Kepler, sitting in Singapore. Kevin, watching China, 100 million people apparently on the move in China for this holiday week. Is that not going to be a pop-up for the sort of the tug of war that demand side is going to win?
It's an interesting one. We obviously have seen a year of those migratory patterns really diminishing. I mean, obviously, Chinese New Year in January, February this year was very disappointing, as it was last year. Golden Week, yeah, I think you're absolutely right. It's a relatively positive sign for demand in this region. I want to go back to a point that Matt was raising just a moment ago about demand elsewhere. There was a very interesting note on the News Digest that was sent out by your staff this morning about American air travel and American air passengers getting up to the highest level for over a year, since March the 12th, I think, of 2020. And that really says to me that, that market is recovering. We're starting to get into the real peak season for obviously gasoline, but also jet. So it's giving a positive sign. So it says to me that, yes, I agree with Matt that the Wall Streeters are in control of crude, but we are seeing a more productive and a more constructive pattern than perhaps we've seen in quite a while.
Rustin Edwards, head of fuel oil procurement, Euronav, sitting in Geneva. Rustin, the situation with India, it continues to be on a scale I don't think anybody can quite get their head around. It is truly a medieval plague that's descending on the country. And yet, from a purely sort of analysis from the energy markets perspective on sort of demand destruction, the markets seem relatively unperturbed that India will derail at least the sort of range bound that we're in at the moment.
Well, I mean, when you look at the scale of the pandemic there, it is a tragedy far greater than I think anybody expected to have happened, because during the first wave, they seemed to go through relatively unscathed versus some of the other countries in the world. But now it's rearing its ugly head and it's becoming very dire in a lot of situations from what I read in the press. But there's also a lag effect on the demand. It is something that, when we started reading stories about the pandemic getting out of hand in India, it was roughly about 12 days ago. And it takes a bit of time for that supply chain to react to something like a pandemic, because it's not something you plan for. It's not like a hurricane that's on the horizon coming in. It kind of hit and it kind of grew exponentially rather quickly. And therefore, the purchasing of crudes and the products being run in the refineries, it takes a long time for all that to flow through. I think we've seen announcements from Indian refiners that they're going to cut back on runs because they're concerned about demand going forward with all the cases coming up. Some of the lockdown or control mechanisms being put in place to keep people isolated more versus allowing them to run free. And, it is going to snowball. It will actually impact at some point here, and it's probably going to start showing up in the next week, 2 weeks of data that start coming out about how much product is being exported. One thing on, just to go back to the comment on the air travel in the United States, one of the interesting ideas or information points around that is that majority of that air travel seems to be vacation travel, not business travel. So there is a bit of bifurcation. Yes, it's up, which is good to see. Americans are getting out and traveling around, but it's all people going to holiday destinations, and it's not the business traveler, which is the crux of major airline earnings. And that may be something that's going to be permeate throughout the rest of the world. We'll be able to travel for vacation, but your business travel will be curtailed, because no company wants to have that risk of having an employee travel on business, catch COVID, and then go down a bad path.
Will that have impact on aviation fuel? Ultimately, the planes will still be in the air. The bit at the front might be a little bit emptier, but the planes will still be, it would appear, up as we're seeing in the US, fairly full of travelers.
Well, it's going to impact jet demand, but it's a percentage of jet demand. I think in the United States, the domestic jet travel accounts for, I want to say like 2/3 of the jet consumed in the United States, and the balance is international travel. So there is a recovery in jet demand. It does help support the refining margin in general. So it does help keep the refinery utilization rates in that 85, 87% range. But we're still missing the exports out to Latin America. Latin America is the one location that seems to have dropped out of the headlines now that India has taken the forefront in the COVID cases. South America is still a bad situation, but you have to dig to find the stories around it. But it's still, their COVID outbreak is still fairly dire. They're handling it a little bit better, but they still have a bad situation going on.
Well, Matt, I mean, this is the new reality to a great extent coming out of COVID. I mean, some of us can use that phrase and many of us cannot. I mean, that is the divergence that the world economy is now going to. We've all sort of shared the same journey of the last year, but we're not going to share the same journey in the next year.
No, I think that we all went into this situation together as one, as a globe. We all shut down. But how we're coming out of it is certainly fractured. The arteries of the Europe and the US are coming out, and the UAE as well, with the vaccination drives, are gravely different from that in South Asia and in Africa. And you've just got to look at vaccination rates there. And it is, again, I refer back to this, it's the reality of reality. Pakistan, it was a BBC article about them at the weekend, about 2% of the country is vaccinated, it's densely populated, same as Bangladesh. It's almost inevitable, perhaps, that may go through a sort of same crisis that India are, and maybe they need to look at what is happening there, unfortunately, and be more proactive.
One thing in Pakistan's favor, perhaps, is there's not a lot of traffic crossing in and out of India to Pakistan, but certainly the other neighboring countries of India are feeling, and there's reports of rising infections. But to come back to the more crass prism of energy markets, with a totally resurgent US EU economy, the biggest economies in the world, the G7 and China, is that going to be enough to sort of get this market up, to support it where it's at and move it higher, given that these are the biggest economies in the world and they're not just sort of growing, they're sort of soaring?
Well, this is why I brought him in, because I think that is the elephant in the room that we need to discuss. The market is bypassing issues in South Asia, growth areas, places like, you take Nigeria, Ghana, South Africa, places that, new middle classes are coming through and they were able to support other growing economies. Is the US and EU and China enough to keep demand buoyant? I'm not so sure. Demand is still down 6 million barrels a day from where we were pre-pandemic, but flat prices at the same levels we are at pre-pandemic. It's a supply curtailment rally and sustainability, and that's how the market has sustained itself. Can that sustain itself when oil starts coming back from the likes of OPEC, and those growth areas like India and South Asia and Africa, as I was saying, are not there to absorb those barrels? Can they just go into the likes of the US, parts of the EU, still a lot locked down there, remember, and China? I don't know, Sean, and I think that's why there's some hesitant trading going on at the minute.
Kevin, there is a view sort of the last year that Asia has dealt very well with COVID, and Europe and America were really the sort of failed states of managing the COVID pandemic. Now, as things emerge into the era of the vaccine and the India challenge, is there a sense that Asia could be now facing their phase of the big challenge?
That's a very interesting question, and I don't think it's fair to generalize and say that Asia managed the first wave of last year very well. There were certain countries within Asia that did. So Vietnam, for example, locked down very quickly and therefore had minimal cases. Singapore is exemplary for the way that it's also managed it. But Malaysia, Indonesia, the Philippines have not been successful at all. And actually, I was just reading this morning, Malaysia is now imposing further restrictions around mosques and bazaars and schools, simply because they have to have to contain the latest wave again. So we're sort of entering a new phase, right? Singapore wanted to open a travel border travel corridor rather with Malaysia across the border, and all of a sudden that's in question. So it's all.
I mean, the challenge of Asia that differs from Europe. I mean, obviously the European experience was pretty bad, but you still have Germany in lockdown and the economy performing incredibly well, right? And the PMI for manufacturing in Germany is off the charts, and yet the country's in lockdown. The problem in Asia is you've got this informal economy, India case exhibit A, and they can't lock down. The economies cannot coexist with COVID in the way that the Western economies have managed. Do you anticipate that might be a challenge going forward?
Yeah, I think, as you say, I mean, if you look at the Indian example, and you look at the sort of informal economy, it's difficult to work from home if you're a migrant worker that is based on a construction site in Delhi, but currently is sitting in Andhra Pradesh waiting for work to restart. How do you get that going, right? It's a very different set of circumstances, a very different challenge. So, yeah, it's as Matt was saying just a moment ago, we all entered this together, but we're all going to depart at different rates.
Going into the European experience, Rustin, I think it appears that the third leg of this sort of global demand recovery, US, China, now Europe seems to be finally joining it. The news overnight of Europe going to be opening up for the summer tourism season. How does it look and feel from the ground there? Is the optimism warranted?
Well, living here in Switzerland, it doesn't feel like it's going to open up. Yes, there's a lot of talk about getting the European vaccine passport. It's still under discussions about what it's going to look like, how's it going to work, what vaccines are going to be allowed. There's currently a disagreement. Are they just going to be the EU approved vaccines? Or are they going to allow WHO approved vaccines? There is a big push to reopen travel between the US and the EU. Just to get that flow of tourism dollars coming back into the European bloc and hopefully pull out of the double dip recession that the EU has entered into. But nevertheless, just as an anecdote, we were looking to take a weekend trip to Italy, and of course the Swiss government, sure, you can go to Italy. The Italian government, yeah, you can come here, quarantine for 10 days, and then you can go about your business. So until these restrictions get resolved around quarantine, what's going to be allowed to travel, what do you need to travel, I don't see how a tourism season can develop anytime soon. The vaccination rates are picking up, thank God, but they're still nowhere near where they need to be. And I'm still not a big believer that we're going to see wholesale travel in Q3. I still think it's a 2022 story.
Matt, it seems, as we said, to use the word that Reuters are grabbing onto this morning, the oil markets are firm. I'm not quite sure what it means, but nonetheless, in the search for anything else, it's certainly stuck. I suppose they can't use that word. They can't say oil markets are stuck. No, oil is firm is their word. Ultimately, it seems now we've kind of run the course of markets moving from wherever they were over the last 6 months to wherever they are now, on the sense of the sort of the world isn't going to end and we're coming to recovery. We seem to now be stuck in a place where now show me the money, show me demand, show me inventory numbers falling, show me aviation fuel coming back. That kind of data point seems to be the only thing, the real tangible demand to really move things from here.
Yeah, you're totally right. And it's firm is another term for a bit boring, I think, Sean, but I'm not as political as Reuters, so I can't comment. But look, I mean, if you're OPEC, you've got to look at the conversation, that talking point from a number of different areas. If you're OPEC and you're range bound between 65 and 70, you're happy. You're over the moon. That's where that's just kind of sweet spot for most GCC economies. That's sort of around that $70 a barrel. US production has plateaued at 11 million. That investment is not coming anytime soon. So that threat that has been there for the last 3 or 4 years has waned. If you're a prop trader investing in this market, you look at it a little bit differently, because second half, there is so much hope pinned on second half demand returning. And, His Excellency Al Jaber, the CEO of ADNOC, he saw during, I think, CERAWeek, which is just after IP week in February, by the end of this year, he sees demand returning back to pre-pandemic levels. You hit the nail on the head, and the guys have as well, Russ and Kevin. They've said, 5 million barrels of demand is supposed to be coming back, half of which is jet fuel. And as Russ said, domestic tourism is good, but the US are doing well and China are doing well, but you can't fly from one country to the other. So it's a little fragile how the
and
market
we're already trading July supply into August.
Yeah, you're right. But I mean, the Brent structure is $2.25 backwardated. So the market does have faith that it's going to make that comeback. But product market gas oil, it's stronger than it was. And I use that as a bellwether because, distillate refining margins have been floating around $5 a barrel for the last 2 or 3 months. If demand does start making that comeback, structure will go bid, which it has done over the last couple of weeks. And that's really what I'm looking at the moment. It's really what I'm concentrating on, just to see those deferred end of the year structures. If they start getting into backwardation, the same as crude, then, those forecasters could be right.
Kevin, are refiners incentivized to increase throughput? I mean, we're seeing just incremental growth on throughput. You would expect maybe that to move a lot faster as we move in deeper into the second quarter.
Again, I think it's difficult to generalize. If you look at the big merchant refiners of the region, especially on the west coast of India, we're seeing refineries trim runs, right? We're seeing Nayara and Reliance cutting because of effectively, and it's not domestic, it's export-oriented refining activity, but because of the weakness in the overall complex that Matt was just talking about. If you've got, your 1 point whatever it is million barrels of capacity in Jamnagar that's heavily dependent on gas oil margins, and those gas oil cracks are $5, $6 a barrel, then you bring in the weighted average of your other products. You bring in jet, you bring in relatively weak gasoline demand. You're going to trim runs. You're not going to be back at the levels that we would have seen this time in 2019. So again, it's a very region dependent and nation dependent question.
Another question that we've talked a bit about on this is the continued sort of friction between China and its neighboring countries, Kevin, and certainly even maybe on this show, I can't read out the tweet by the Filipino foreign minister, but it's essentially get the F out of my water, more or less. I mean, a foreign minister may be comical on one level, but on another, it's clearly frustrations growing there.
Yeah, I mean, the comment itself is, it's comical from the point of view of how senior that person is to be making that sort of language. You're using that sort of language and making that sort of comment. But we've said this before, that the Duterte administration has started getting more and more aggressive about China's incursions into its territory or into what it sees as its territory. So the move in itself might seem, the tone of the note might seem a little bit humorous, but it's not out of line with the Philippines standing up and saying, actually, China, we've had kind of enough of this. And I think, there are other parts of Southeast Asia that are being emboldened as well. At some point, people are going to point the finger, or people have been pointing the finger at China and saying, you started a lot of the problem that we've seen over the last year. And if they see that there's support for that kind of stance, then they're going to, like I say, get emboldened into sort of making stances and aggressive comments in other areas as well. And I think that's probably one of the aspects of what we're seeing on the territorial side.
I mean, it seems like every day that goes by, we're a day closer to this something triggering something that is problematic, let's just say, and sucks in the Americans to have to back up one of their allies, perhaps, and this thing all sort of snowballs. Let's go to the survey question and give the room a view on the thoughts today. The Indian situation is playing tug of war with optimism over a rebound in the West. which will win over the course of the month of May? The India optimism, prices higher, Western recovery, or India and further COVID pandemic, prices lower? Or is it stalemate, stuck, firm, as the Reuters are calling it this morning, range bound? Which will win this tug of war in the month of May? Month of May. India hopefully won't last more than the month of May, but we'll deal with that if it goes into June. But at the moment, this tug of war in the market, which will win, or will it be stalemate through the month of May? Rustin, your thoughts on that, and also give us a sense of where are shipping, where is fuel oil?
Well, I think there should be a caveat. Does the Biden administration and Iran come to an agreement here in the next 10 days? Because I think that will have a far greater impact on the range of oil than Indian COVID cases, and that seems to be moving rather quickly into an agreement situation. I mean, you have members of the JCOP saying by the end of the month we'll have an agreement in place and things will go back to the status quo pre-Trump. So let's see what happens in that regard. In the state of shipping, freight, tanker freight has not recovered yet at all. I mean, it's still relatively low on the dirty ship side, just because the amount of, even though OPEC has increased their production to the market, it's just slightly moves the needle. It doesn't really help with the supply situation and the oversupply of freight. So we're still expecting to see hopefully a Q4, Q1 type recovery in tanker markets. But that's still to see how much crude actually comes back into the market and what the overall world demand profile looks like going forward. If Iran does happen, or the sanction relief on Iran does happen, that's an additional 2.5 million barrels onto the market, of which is really only maybe 1.4, 1.5, because the other is already in the market, just being moved on, let's call them dark ships, that are in the black market trade right now. So that just means there'll be an additional 1 million barrels of new supply into the space. But that's what I think we're all in the tanker space looking for. Fuel oil markets, I think they're in a relative oversupply type region at the moment. Container traffic is starting to get off the spike that it was in the past, let's call it 4 months now, as logistics systems have all adjusted. The Suez Canal ramifications are all taken care of reportedly. Different port facilities in the markets are saying that they've cleared their overhang of ships and the overhang of cargoes to move. So, systems are getting back to normal. I think that, any hiccup in the logistics chain because COVID spikes even further, that's yet to be seen, but that could just be another impact that's going to cause curtailment of ship movements. One of the issues right now is that with this spike in the Far East, Singapore has already started to ban certain countries coming in to do crew change. And that's always been, from a shipper's perspective, the hardest thing to accomplish, is getting your crew rotated on the ship safely and effectively so that the ships can operate safely.
It seems that there's more ports blocking ship crew changes than opening up for them.
Yes. And to me, it's kind of, if you can't keep the baseline logistics systems running by allowing crew changes to happen on a regular basis, how can we open up travel for global tourism?
Yeah, when you're talking about a few hundred people. Matt, the other tug of war that's ongoing, it seems to me that's sort of a medium-term issue, but I'm wondering when does it become more imminent? And that is where investment is lagging the price recovery. We saw last year investment in new oil and gas supply hit a 15-year low, cut of $350 billion. Where does that start, the absence of that investment, start to become an upward pressure on price? And of course, it sits alongside the fact that there's still 8 million barrels of idle supply.
Yeah, that's a very good question. I wonder how much of that investment in fossil fuels, generating energy, has gone into renewables. You've got a big focus at the moment on hydrogen. I think that's a sensible discussion that needs to be had. I think a lot of that money, the big funds behind us, is going into renewables. Shell have got a big drive on it. Vitol have just bought a a hydrogen plant up in Norway, I think. So the majority of traders are already hedging that fossil fuel energy production will drop off over the next couple of decades. That's Greta's had her way. I hope she's on the board of Equinor and Vitol. That would be a brilliant board meeting between Russell Hardy and Greta Thunberg. I'd like to be there for that. But yeah, so that's certainly on the agenda. The other part is you wonder the US banks, you took a hit last year on a sizable number of US drillers, and there's still a lot of drilled but uncompleted wells in the US at the moment. You wonder how much.
And Vitol seems to be buying a few of them as well with an acquisition that was highlighted earlier this week. Yeah,
that might be a spread. They might have a Permian Basin versus Norwegian hydrogen play going on that no one else knows about. No, you wonder how much more sort of equity that these US shale producers need to have in their balance sheet for the banks to feel comfortable that the business model can sustain another crash if there is one coming. I mean, you would be naive not to think the prices are a little fragile right now, but OPEC, it's clear, will do what they have to do to ensure stability in the market. They did that last year, and they'll always have that up their sleeves. Investment into the oil patch,
or the absence of it. I think some point as the supply tightens and you expect inventories to decline, it becomes an issue, but perhaps not at the front month. Kevin, last word. Let's get the survey result today and see where the room is at. Stalemate, range bound seems to be the view in this group. Looking at the week that's in it, Kevin, we've got inventory reporting to start today, API, EIA tomorrow. Your thoughts on that and what it might mean for the markets?
Yeah, just in the sort of preparation space before we came on air today, I was actually looking at global inventories and where we are now relative to where we were sort of at the peaks. But looking globally, looking at the US, looking at China, all of those inventories have actually started to draw. Now, we're still above the 5-year ranges, but the fact that we're starting to draw perhaps tells us something. That's made the point a couple of times about the fact that the recovery that we've seen in prices has really been driven by supply constraints. Right? OPEC has taken 6 million barrels off the market, but we're actually starting to see the impact of that on inventories. And I think that, as I said earlier, starts to be a little bit more constructive going forwards into the middle of the rest of May.
Well, I think you do have to bake into your thinking that this OPEC plus discipline is here to stay. There's been certainly sort of views at the start of the year that it wouldn't hold. Clearly, one would have to acknowledge that they are holding the line and are well incentivized to do so. And everybody has to sort of manage their portfolio from that perspective rather than be too distracted by the 8 million barrels sitting on the sideline. Listen, we'll leave it there. Rustin, thank you so much for joining us from Geneva. Matt from Dubai, Kevin from Singapore. Thanks, everybody. Have a great day, and we'll catch up with you over the coming days. All the best.
Cheers.